It's been an exciting year. It's been an exciting start to 2016, watching the stock market be as volatile as it has been. It's been that way, last year, 15 was a lot of up and down movements. We sort of ended the year where we started the year, but we were coming off one of the most important and powerful runs that we had ever seen. And let's go back to when the market in 2007, had hit a previous all-time high around 14,000 on the Dow Jones Industrial Average. Within a year and a half, it had lost more than half of its value. By March of 2009, it was down to 6,500. Okay? And a lot of people really were certain that it was going to go to zero. So they decided, we got to get out of this thing. We watched our 401k take a beating. We got to get out of this thing now before it goes to zero, before every stock is worthless. Okay? I don't know what happened on March 9th of 2009, but that was the day that investors drew a line in the sand. And they said, we're not going to put up with this anymore. 6,549. The rally began on that day. And we got to as high as 18,000 in 2015, at the beginning of last year. We got to 18,000, from 6,547 to 18,000. And today we're around 16,000. We bounced around here a bit, and we're down to around 16,000, give or take a little bit, okay? I don't know when we're going to make that next big move up in the stock market, but it will happen. And I can also guarantee you one thing, you'll never pick up the Wall Street Journal and the headline on the front page will say, rally starts tomorrow. Okay. So what it comes down to is, you kind of have to make a decision. Are you going to be an investor or not? And if you are going to be an investor, you got to approach it in a way. That doesn't mean you have to be all in or all out. Wayne Gretzky, another great investment mind, once said, "You never score a goal if you don't take a shot." So you've got to have some money exposed to the stock market, especially if you have grandkids. Especially as you have grandkids. One of my favorite books on investing, and maybe my favorite book, is called "Winning the Loser's Game." "Winning the Loser's Game" is the name of the book. Charles Ellis is the author of the book. I think he first wrote it in '76, and in the book he wrote a chapter and that was a real eye opener for me. Even though it just said something that I knew was the case, but I never had really put it together the way that he did. And he said the logical thing. He said, most people as they get older, they make investment decisions based upon their own life expectancy. Okay? They're retired, they're on a fixed income, and they have in their mind this attitude that they can't expose their money to risk. So unfortunately, what does that mean? They put their money in short-term treasury securities, they put their money in short-term certificates of deposit, and they earn 1%, 2%, maybe. Trust me, San Diego County Credit Union would love to pay you more on their certificates of deposit if they could, but they can't because that's what the market is right now. And I just told you the Fed's not going to be raising short-term interest rates anytime soon. So we're stuck in this situation. And for those of you on Social Security, you already know that, 2 years in a row now, your cost of living increase was zero. Nada. Nothing. Okay? And it's going to stay that way probably for another year or two, maybe even longer than that. So the biggest challenge every one of us faces as we get older and as we move into retirement is inflation. Now, inflation is very low right now, but even when it's very low, every year it eats into the buying power of your dollars. So let's say, as I mentioned, inflation rate in San Diego County running about 2.5%. You're earning 1% on your money. That means the buying power of your dollar goes down 1.5% every year. And it's actually much more than that, isn't it? Okay? I drive a lot, so I benefit from the fact that I don't have to pay as much for gasoline as I used to. Okay? My wife drives 2 miles to work and 2 miles home. She fills a car up once a month whether she has to or not. She could care less whether she pays $5 a gallon or $2 a gallon. It doesn't make any difference to her. Okay? For me, it makes a lot of difference. Okay? So that's one thing. We all have our own internal cost of living situation. So you look at this situation, and so there's basically 2 ways that your money grows at a rate faster than the rate of inflation, and both of them require the acceptance of some risk. One is real estate. The other is investing in the growth of the stock market. So you've got to find a way to do these things, hopefully. Now, what Ellis says in his book is instead of making investment decisions based upon your own life expectancy, make investment decisions based upon the life expectancy of the people you want to leave the money to. Okay? Since our kids have pretty much sucked us dry, they've gotten everything out of us they're going to get from us. Okay? We now make our investment decisions based upon the life expectancy of our grandchildren. A baby born today has a 50-50 chance of living to be 100. Okay? Our earliest grandkids are 11 years old. That means my time horizon for the investments I make targeted toward for them is 90 years. Okay? I can pretty much guarantee you there's going to be a lot of ups and downs in the market over the next 90 years, but I can tell you that over time, as it has always been the case, stocks will go up dramatically.